What's going on, guys? Brian's here. Today is Saturday, March 4th, 2023. The days in which we're going to be reviewing is the Thursday and Friday of this week right here. So this would be the 2nd of March and the 3rd. The reason I stress the dates is because these videos are intended to be referenced in the future. And I'll be talking predominantly about options, most importantly, implied volatility and gamma exposure. Jumping right into it, we have the only indicators on this chart right here would be the 200-day moving average and the 50-day moving average. We have the 200-day moving average, which is a very important level. So at a very, very simple level, if you've watched any of my other videos, you know I like to talk about confluence. If we just look for one simple reason to necessarily look for long entries again this week, we have the 200-day moving average, and price was selling off 1, 2, 3, 4, 5, 6, 7 days. We have 7 days into the 200-day moving average. What we're looking at is the SPX on the daily time frame. Sorry, I should have mentioned that at the beginning of the video. Each of these candlesticks represents 1 day's worth of price action. We'll be looking at the SPY and the SPX and the VIX. I've been looking at the VIX for years. A lot of traders use it. It's a proxy for a lot of things. Sometimes it's called a fear and volatility index, but it is largely comprised of SPX options. We can use SPX or SPY again for our analysis. For the purposes of this video, it's not that important. The SPX chart tends to be a little bit cleaner. There's no volume on the chart, so I'm just using it to show you guys some of the price action right here. So reason number one, if we were just to list out some of these reasons, we have market was selling off for a few days, and if anybody knows, if you follow any type of data or any type of stats around the S&P 500, the SPY, the SPX, if the market is down past 6 to 7 days or so, it generally has very low odds of continuing lower given that time period. Doesn't mean we won't put in another leg down, but for that time frame, if it's been down 5-6 days, you can almost expect a green day to happen. So that's reason number one. The market's been down for a few days, right? Reason number two to look for a long entry is we have the 200-day moving average. So we already have two reasons right off the back. That's not enough necessarily to take a trade. You definitely don't want to trade against the trend unless you really understand what you're looking for and you know how to build upon confluences. Now let's just dive into a smaller time frame right here. And what we have on the left hand side again is the SPX. This is a 30-minute chart. This is the week here, so this is from the Monday and this is to the Friday. And actually, before we jump into that, I want to show you guys, we will be taking a look at a lot of options here. So this is like the 4,000. If I say 400, I'm using it again interchangeably with the SPY. On the left-hand side, we have the SPY. 4,000 on the SPX ends up being a little bit around, I don't know, $399 and maybe 90 cents or 50 cents or something like that. It doesn't really, again, matter for the purposes of this video. If I say 400, I'm talking about 4,000 on the SPX. If I say 4,000 on the SPX, I could be talking about 400 on the SPY, give or take a few points on the SPX or so. And we'll be looking at the 0 DTE options, which is something I don't really generally talk about that much on this channel, because if you've watched any of the other videos, I predominantly trade option spreads versus just buying a long call or buying a long put. However, a lot of the times, especially with the given market right now, there is a lot of opportunity in actually just trading the long call option. You can just buy a call option, 0 DTE, 1 DTE. It might go against a lot of other videos in which I've talked about, but however, the opportunities given right now, it far outweighs the risk if you're actually trading some spreads. So now let's just jump back to the chart here. We will be, again, jumping into that a little bit later. This right here is the meat of the video. So if you don't make it throughout everything in which I'm sharing, I just want to show you guys some of the options we'll be looking at later. But if you want to get to the meat of this video, this is it right here. On the left-hand side, we have the SPX. On the right-hand side, we have the VIX. This is something I've spoken about in many videos. It's spread all over the channel. And if you are part of the Quant Trading App Discord, this is something which I've been talking about for the longest, and we will actually reference this point right here. So this was on the Thursday. I'm currently on Pacific time, so this time frame right here, just add 3 onto this to get the Eastern time, so the time the market was actually open. So this would have been about 11:50 Eastern time, New York, so market time, whereas the timestamps in which you're seeing is 3 hours before. So I just wanted to clarify that because I know a lot of the other videos I'm actually on the East Coast, but I'm bouncing around a little bit, which is also why I'm recording this video on a laptop. If you notice anything's different for some of the long-term watchers of the channel. So on the left hand, we have this is Gamma Exposure chart. Again, we'll be talking a little bit more about that in a bit, and as well as this right here was essentially telling people within Quant Trading app what to look for a potential long entry. Now, I was actually expecting this to happen on Friday. However, shortly after I posted this picture, the level to trigger to actually get long happened. I was not aware of it at the time. However, I like to share the information before it happens. So any type of user, if I'm aware of it, because I understand some newer people or people that have not been trading the market that long don't know to look for these types of things, and that's the purpose of why I record these types of videos, so that way you guys can reference it, learn a little bit more. So this right here is the VIX before the VIX actually broke down, which was very important. If we break down why that was important, so the reason I just want to show you guys again the Quant Trading app Discord is just so you guys know this was something I was aware of a few hours before it happened, as well as sometimes you can be aware of this days in advance. On the left hand side, I marked off this A. This matches with the A on this point right here. Again, this is the VIX on the right hand side. The VIX is comprised, it's proprietary, I believe, to CBOE, which is the Chicago Board of Options Exchange. They calculate it, and then we get a number right here, and it is, the last time in which I checked, it is calculated based on the 30 DTE options for the SPX. If there's an influx of people buying, puts within less than 30 days till expiration, that's going to affect the VIX. As I'm oversimplifying it and understanding the actual nuances of how it's calculated is not really something that I think is going to provide much edge. However, whenever you spot these types of divergences, it can be very powerful. And I'm not talking about divergences on a 1 minute time frame intraday. We're talking about big moves within the market that takes place over a few days. Obviously, big is relative. A 5% move in the market might not be considered big to a long-term, investor or something like that. However, for most of us right now that are generally short-term traders, we have plenty intraday traders. If you hold positions for less than 3 or 2 days, that's kind of who I'm talking about, or anyone that holds a position for around 2 days to 7 days. That's generally the target audience, if you will, as someone I would expect that would be watching a video like this. So on the left hand side, we have the SPX trading around 395. Let's actually we'll keep it for the SPX. If these numbers, I have a screenshot here, and to keep it simple, let's just pull up the SPY, because it might be a little bit easier, again, because the numbers are smaller, and I don't want to keep duplicating or repeating 3,950, as it will take me forever to keep repeating these digits. So here we have the SPY A, here's the same VIX chart, and then we have a few days later, so on the Friday, we have the Wednesday of this past week, this would be B, however, we have the VIX at B right here. So I'm going to refrain from actually just calling out the numbers, again, just for simplicity of getting through this video, and to refrain from having to take a sip of water every 60 seconds because of my mouth running dry. Right here, A, B, A, B. If I was to show this to an 8-year-old and I told them, hey, here's A, here's B, draw a line between A and B and tell me if you notice something. If they did something like this and they say, hey, that goes, right across. And if they say connect A to B and they say, hey, this one goes down, I would say, does this look exactly like this? And anybody, with past I don't know what level of grade school would be able to determine these charts do not sync up and they do not match. That, in a sense, the fancy word for this would be divergence. Now, why is this important? We have a Friday and we have a Wednesday. 1, 2, 3 trading days has passed by, and the price of the SPX from a net change perspective has not moved. If it was at this price and then 3-4 days later it's at the same price, from a net change perspective, it's 0. However, the VIX in this case has dropped significantly. The percentage drop, not necessarily relevant, but it's somewhere around 10% or so. This is the divergence in which I'm talking about. I'm not interested, or in my opinion, it's almost, it doesn't make much sense. Again, to me, I'm not a short-term micro scalper, and if you're a short-term micro scalper looking and paying attention to this type of stuff, it's not really that important, because you should essentially just be reading the tape and trading exactly off of the price action which you see in front of you. If you have to take your eyes to analyze this type of stuff, sometimes you miss the trade in which you were trying to take, and sometimes those trades only last 30 seconds, 45 seconds or so, and you're competing with high frequency trading programs. But if you're someone that's looking to analyze the market and put on, intraday position trades where you're holding for a few hours, or you're looking to hold something overnight, that's more so what I'm talking about here. We're talking about something that took a few days to develop, and it doesn't happen frequently, because I've done videos in the past about the divergences in the VIX, and then within QTA, which is the Quant Trading app Discord, I'll have certain members, say, like, is this divergence, and we're talking about, just something that went like this. Generally intraday I won't even notice something like that because it's too small. The time frames here are 30 minutes, and you want to be able to catch divergences on larger time frames, and obviously larger relative. I'm not talking about weekly. If you find a divergence on a weekly time frame, that's amazing. However, your time frame might be, you might only be holding your positions for 2 days, and that type of information, there's a point of diminishing return digesting that level of that amount of information. We can say this is a good medium using the 30-minute time frame, 20 days. This is about a month's worth of price action trading activity here, and you're just looking to make a decision for the next couple hours or next few days. This divergence is important because the implied volatility, again, we're using the VIX as a proxy for implied volatility. The implied volatility would have dropped for the SPX options. Now, why is that important? We know a lot of negative gamma was in the market, right? A lot of people were purchasing puts over the past few weeks. Now, how do I know that? There's all sorts of tools to find that type of information. Right here is just a few charts of some gamma exposure levels, and it is archived within the quant trading app platform. So we're going to take a look for very briefly. This would be Monday, right? So on Monday, this screenshot was taken and it's actually sent out to the Discord, and then it's archived. And we can actually jump back to these timeframes and actually take a look at what the gamma looked like at that point in time. We can actually get a little bit of a snapshot regarding how much open interest there was and how much call or put open interest there was in the market, right? So to keep it simple, we're taking a look. This was the spot price. So at the time, this right here would have been the Friday at 9:45 Eastern time. So 15 minutes after the market opened, we can see that this is where the SPY was traded, and we can see a ton of negative gamma right here at 390. And this purple level in the background is letting us know that there's a lot of absolute gamma at that strike. Just means that there's a lot of gamma. Again, going to oversimplify a lot of things because I'm compounding a ton of information into one video, and I really want to cement a lot of what's going on into anyone's watching this video's mind, because this information can lead to a lot of potential income for anybody that understands this. So on the left hand side, again, 390, a lot of negative gamma, and we can see that this was at the start of the week right here, and it's saying this is for the March 3rd expiration. So when the screenshot was taken, it was taken right here, which would be the 27th, which was the Monday, but it's for the upcoming Friday end of the week expiration. We can see a ton of gamma right here. Now, even if we take it a step further, let's head over to the Discord for a second, and let's jump to this right here. And I scrolled, let's scroll all the way up to the top right here, and we have this would be the 24th. So this right now would be the Friday prior, and this is analyzing the upcoming week's gamma exposure. So in a sense, this is now 7 days in preparation. We can take a look at kind of, I call it the GEX profile. So I'm not sure if there's a technical or specific word. These are just terms in which I've just been calling these types of pieces of information here. If we pull this up, let's take a look at, this would be the middle of the day Eastern time. So let's take a look at about an hour after the market opens last week, Friday, again on the 24th, not the 3rd, but we're analyzing all the options expirations from the 27th to the 3rd. We can see a ton of gamma. Now, how much negative gamma is at this level? It says it right over here. Greater than negative 140 million. Now, I know with experience, anything greater than negative 100 million gamma exposure on the negative side is significant. This is going to be a very dominant level, and then on top of that, we can see that it is the absolute gamma level. It's that big purple level in the background, and that's why it's just letting us know that. If you've never heard of this before, think of it this way: the bigger these purple levels are in the background, the even more powerful the level is. If you don't understand that this level being so big on the chart means it's a powerful level, then the purple in the background is letting you know it's even larger. So that's important to know, because it means if it's going to take a lot of momentum, or we can use physics in a sense, it's going to take a lot of energy and momentum to actually get us past this level. The reason this level is also so dominant is because implied volatility was high last week, but we know as we take a look at the VIX chart that was around here. This week, the implied volatility has significantly dropped. When implied volatility drops, it means the price of options decreases, with an emphasis on put options. Put options are inflated. Options in general are inflated when IV is high. However, put options really get inflated because there's so much demand whenever there's a lot of fear in the market. If people are afraid, which is a very strong emotion that drives price action, people are willing to buy puts at the ask. That means there's a lot of demand. A lot of demand is going to drive price up. That's just basic supply and demand principles. However, options has an extra component to it. The implied volatility is also going to increase. That's going to help the option sellers offset the risk that they're taking by selling those put options. If that did not make much sense, don't worry about it. I just felt inclined to say that for those of you that have never heard this before. It's something you'll probably hear a little bit later in your trading journey. Just know that's important. When implied volatility goes up, it means the price of options also increases. However, the price of put options really increase as there's a ton of demand for it. And then what we end up having is the VIX also starts increasing because again, they're all tied together. A lot of oversimplified explanations to things, but it's the only way to get a video under 45 minutes or so. I have no idea how long this one is going to be. So implied volatility has dropped. Again, this is a proxy. I'm not saying implied volatility has dropped just because that's what we see on the chart. However, it's very likely that implied volatility is lower when the market was at A, and when it returns back to that same price at B, we can infer or we can expect that implied volatility has decreased. The way we can do that is just by taking a glance at the VIX. The VIX should be all the way back up here, or at least within this vicinity. However, it is not. The levels that you see on this chart, by the way, are calculated by the quant trading app algorithm, and these are referred to as the buy and sell zones, and these are weekly support and resistance levels. And then we have 2 sigma levels on the outer skirts, as well as some of these gamma levels that you'll see are plotted on the chart. So what I have right here is this weekly support level, and if we were to go back to the gold chat here and scroll back up to the level in which I first mentioned this, I was just talking about weekly options, just an example for 0 DTE options. This was the previous week of what to expect. This was about 1,000% return right here that I was trying to show. That's the type of trade in which you'd want to look for, because that's what's in a sense building. I had shared this screenshot for the gamma at that level, saying that there was a lot of gamma still. This now was for, again, this when I took this was on Thursday, and I was talking about the 1 DTE option expiration, and I was still showing how there was a ton of gamma at 3,900, as well as a lot of interest at the 400 level. There was a lot of volume coming into the 400 level. That was also the 4,400 level, as that was max pain for the Friday expiration. Now, the current price was around 39.50. The thing that's important here is there is a very little gamma exposure above 39.50. The next closest positive gamma strike was 39.80 right here. So the level in which I called out or I mentioned was the 39.80. However, when I was doing this analysis, I was actually going to be stepping away, but I did not want the members within QTA to miss out the opportunity, and which was likely to come. So I was saying once this level breaks here, once we break the Tuesday low, I believe that's what I was mentioning here. So yeah, once we break Tuesday's low, we can expect a nice green day for the SPY. However, I was talking about for Friday because I like to do my analysis the day before. So if you're looking for one trigger, as we started from the top-down approach on the daily time frame for the SPX, we already spoke about the 200 SMA was there. We spoke about how the market was, in a downtrend for 6 or 7 days or so. And now we're building on that from a more advanced approach, because when you first start your trading journey, you just learn, usually it's just technical analysis and just trend line, support and resistance and things like that. This is a little bit of the next level when you start trading options, and when you start learning about gamma exposure and the impact of implied volatility and put and call options, and some of the more nuanced things you'll learn about a little bit later. So we started from a simple, again, daily time frame. Everybody has access to that. Now we're drilling it down. Okay, so here's the VIX, and the VIX is now essentially forming a double bottom. Let's take a look at price action. We have these SPX has gone lower now, but yet we have the VIX, for whatever reason, we're now talking about Thursday, it's not really showing the same enthusiasm for going higher. So we already showed that implied volatility has decreased, and now we're seeing implied volatility is still decreasing. So what I was just letting everybody know is if the VIX breaks this level, that's essentially, the place in which we'd want to look to be long. You can use that as one of your triggers for when do you enter, because it's one thing to do any type of analysis on the market, but then it's another thing to be a trader and be able to say, well, when do you enter the trade or when do you exit the trade? The reason can be 200-day moving average, your reversion to the mean, the market's down 7 times, and in the past 100 occurrences of the market being down 7 days in a row, 80% chance that the ninth, the 8th day it's going to be up, or 95% of the time by the 10th day it's up. So these are a little bit more statistical reasons. And then next you have the price action. We have a double bottom. We have divergence happening, and we're just building on the narrative and the story as to why am I taking the trade. Opportunities like this, by the way, this belongs directly to my playbook. This is a type of trade in which I've been taking for years, and it excites me every time it comes about. It's not something that happens very frequently. It did happen a lot last year, and it led to a lot of plus 6-7% rallies in the SPX and the entire broader market, which is almost an entire annualized return that can be realized when you're able to spot these types of opportunities, which is why the options went up over 1,000%. As we'll take a look at. Moving right along, if we talk about price action, we have right here a hammer candle, or some sort of a hammer candle right in a QTA buy zone. If you don't use some sort of program like this, you might have some sort of demand zone, and you're essentially thinking about, where do I want to get long? If you're a completely new retail trader, you might have a support level here. You might look to get puts because we gapped down and we broke support. Without having some sort of context on your chart and knowing this is not a good region you'd want to be getting puts or you'd want to be shorting, just because we broke support is not a reason to get short. You're essentially getting short in an area where there's probably going to be a lot of liquidity for people looking to buy, because this is where everyone's stop loss is. Everyone's stop loss is probably below the wick of the week here. Not understanding the context, you're essentially selling your positions when this is exactly when you should be either getting long or actually looking to scale into a little bit more of your position. Now let's talk about targets. If you guys notice, look at where the market essentially is stalled out right here, and within this vicinity, and it's the 39.80 level. Why did it stall out at 39.80? If we pull back up the Gamma Exposure chart here, this is something I ended up having to reiterate and share. This is a quick little tip for you guys that are new to Gamma Exposure. If you see a ton of Gamma, if it's all negative, in this case, we'll just talk about the negative gamma, and you see prices below the absolute GEX, or below, a key strike here. This is 39.50. It's a key strike, period. It's half of the hundreds. Those are always going to be pivotal levels. In this case, it ended up being the absolute gamma strike. And then on top of that, you notice there's barely any gamma, but it's all negative. And then you notice the next level that's positive is all the way up here. This level is essentially going to be your target. You can use that as your target, because if this level breaks and there's no real resistance, it's naturally going to gravitate towards the level in which that's where there's a lot of call interest for. And we can see 39.75. There's a decent hump right here. As we can see, that's where a lot of the call volume was going for the day. It's the most amount. Hey guys, so after I was done recording the video, and I realized when I was explaining this, I was using this screenshot here, but I figured it'd be easier to illustrate what I was showing by actually pulling up the interactive chart to fully articulate this. So this screenshot here was taken, I just pulled this straight from the Discord, just showing you guys just after the market had actually made, after we broke the level in which we've been talking about, and we started rallying. I was just saying that there was a little bit of GEX within this vicinity, so that's the same level in which I was talking about here, and then again pointing out this 3,980 level. And then I asked a couple of the members if anyone understands that, and then a little bit later in the day, a few of you guys were asking questions, as I don't think you guys completely understood because you're new to quant trading app, and that's actually what sparked the idea behind just making a video to fully explain it. So if we jump back over to quant trading app, and we're just pulling up the archive GEX here, and we come to that timestamp that was at 10:17 Eastern time. So this is the same graph in which we're looking at here, 10:17. This is the same one right here, 10:17. And again, this is all just being published right here. So I'm just pulling up that information, coming to it here, and then let's actually recreate the graph. So now it's just going to populate the data, and we have this here. Again, the same graph. Here's that level, 39.80, but now you guys can see we can hover over it, and then I can actually turn on the absolute GEX, and that's what I actually wanted to show you guys. So past 39.50, we can see that there's very little absolute gamma until we get to this level right here, and this level is 39.75. So price will naturally move between this void relatively quickly until it gets to that positive gamma strike if you have some sort of a bullish thesis, and that in a sense is what this video is mostly about. We were coming in with a bullish thesis starting from the daily time frame, using this as our target, but being aware that this is likely where we're going to meet some sort of resistance, and hopefully seeing it on the chart like this helps illustrate illustrate it, if I turn off the actual NetGex and let's turn this off and let's take a look at where the open interest was, we can see that there was a ton of open interest right here on the put side. And there was also a lot of gamma at the 4,000 level because there was a lot of puts that were actually in the money at this level. So 7,762 puts that were well in the money, 60 points in the money at the time of this picture. So this is something that we'll see. The market would like to rally towards the strike price that has a lot of puts that are in the money, because the market likes to close above strike prices that have puts that are deep in the money. So this strike price right here, the 4,000 put, these puts are about 60 points in the money and they expire 1 DTE. So by the time the market closes, the price would like to be closer to this level or above it. Same thing works in reverse, but however, you won't really find people complaining if the market is going up, because that's the way it's engineered to operate. It's generally created to go up, not go down. Okay, so now let's just jump back to the previous recording. So this is likely to be some sort of resistance here, 39.75 before it gets to 39.80. And I believe we can take a look at that on the chart and we can see that it hit 39.75. So right here, and that's where the first red candle ended up forming once we actually broke. Now we broke this level the same time this level broke down, and that's why I just have this arrow here. So the moment this breaks, you can decide to take an entry here long, use your own discretion. Obviously, I'm not a financial advisor. I'm just showing how, or educating on how I analyze this type of information. It does not take as long as these videos are. It's just that I've been doing this for a few years, and that's why I'm trying to condense a lot of information. For me, I can just take a glance at this, and that's why I'm making sure to at least share it within Discord whenever I get the opportunity to, but at the same time trying to really condense the information. I used to type out 3-4 paragraphs explaining why this is happening, and now it's just more just drawing a couple levels on circles on the chart here. In this case, I was just talking about why I had a double calendar on, and I was not yet sure if the market was going to go to 3,900 and then ending up on Friday rallying back up to 400, because at this point there wasn't necessarily the reason to be long from a price action standpoint, because the market was still trending down. However, we have 39.80. So it looks like 39.80 would be the line in the sand as resistance. The reason I got that level was just because of this. If the market was to stall out, that's the level that the bulls would be able to win the battle to. Past 39.80 was not necessarily sure if we would get past 4,000, but this was almost the for certain target here or strike. The reason being, now to understand this a little bit more, why would that happen? There's a ton of negative gamma. That means a lot of people have loaded up in puts. Oversimplifying it again. I just want to make sure I'm clarifying that. A lot of put purchase will influence there being a lot of negative gamma, right? So if we take a look at this, all of these puts purchased, all of these puts are going to lose a lot of value. If all of these puts lose a lot of value, the market will naturally look to go up. It's just the dynamics of the influence that the options market has on the equities market. As everyone purchase all those puts, they're likely to start closing them. So the market has been going down. Everyone's buying a bunch of puts. However, implied volatility is not going up with them. Implied volatility is struggling to head back up. So everyone's buying these puts, and these puts are continuing to deteriorate because of time decay. And these are puts that expire within 2 days. So from the Wednesday and then on the Thursday, these puts do not have that much time left in them. In order for them to sustain their value, the market needs to keep going down. However, if the market is stalling out, it leads into these principles known as Vanna and Charm. Those are other things in which you can look up on your own. I've talked about them in some of the other videos, but we have Vanna and we have Charm. These are based on time, and this is based on implied volatility, right? So what we have is time is passing by, and we have implied volatility is decreasing. Once that combination of those two things are happening, it will lead most of the time to a rally occurring, because people are going to be closing out a lot of those puts, and naturally market makers will be buying back their shares. I think if you're a beginner trying to approach the market and trying to understand every single thing that market makers are going to do will drive you crazy. It's not your job to be understanding exactly what their algorithms are doing. It's not like the market maker is one guy behind a desk that's pushing buttons. These are machines that are calculating this, and it's happening every second that the market is opening. It's happening, and they're using the futures to offset risk. They're using the entire market to offset their risk. So they could be short some put options, but then at the same time they're getting long an equity, and then at the same time they're selling futures contracts, and it's a very complex system that they have in place. So it's not as simple as saying like, oh, the market maker, this guy is going to do this because of that one thing occurring. It doesn't necessarily work exactly like that, but everything is kind of working in tandem, and the market is a living, breathing place because it's us behind it that are, by us I mean people, are actually driving what's happening with price action. So with understanding that, if you can just at least grasp this, and I'll repeat this, and I actually think I'm going to do another video that's a little bit shorter of version of this video where it's just to the bullet points of what's actually occurring. But what we have right here, the market is going down, and it's been going down for a few days. If we actually zoom out just to get a little bit more context, the market has been going down, and implied volatility had also gone up. So this was the spike in implied volatility if we take a broader picture right here. So boom, the market sells off all the way to A. Market sells off, it goes all the way to A. However, then the market tries to sell off again. It actually goes a little bit lower. So the market goes like this. This should go all the way back up here to match this chart. So if we were to just draw, if we do this, it forms this H here. If we do this, it doesn't come back up to the same point. This right here does not match this. If this doesn't match, it means something is happening within the options market that's not matching what we're seeing on the chart. If something's not matching what we see within price action, you can infer, you can anticipate, you can expect. You don't want to say you're predicting, you just want to say that it's strange. And if you spot something that's strange, it means there might be an opportunity here. The opportunity in this case is to go against the trend and essentially say, hey, maybe I should take a look at some call options because there's probably an opportunity here, because all of these puts are going to lose in value. So at worst case scenario, the market continues to go down and you're in some really cheap call options and you're not losing that much because the risk reward is in your favor. On the other end, the market could just end up stalling out. If we were to jump back to this right here, this would be an example back on November 3rd. And the reason I'm pulling up that example here is because that was also an important time where the gamma had a massive impact on the market right here. So this is the November, I believe, November 3rd right here of 2022. We can see that the market stalled out right here and it struggled to go lower. And this is at a very powerful level of 370. And as I pull this up, this is the SPY. I can pull up the SPX gamma charts right also, but going to keep this again simple now and just use the SPY, as I can switch this over to the SPX. But we want to just keep these charts on the SPY for this example here. So we pull this up. What do we have? We have 370. Ton of negative gamma, almost 100,000, and the market is right at this level. This is 15 minutes after the market opens. It's sitting right on top of this level. However, at that time, implied volatility, similar situation with the VIX. The VIX had not gone as high, and we can see that the market opened on this Thursday. So that's why I'm saying market opened Thursday right here. This is the 37 level and the 370 level, and then we can see this is now the Friday. So this is at the close. It closed just about right here, baits everyone in. Everyone thinks the market is continuing to go lower. Market opens the next day, comes back down, and then ends up still just stalling around 3,700, and then we can see the rally ends up starting right here, and then it ensues into the following week. So taking a look at the rally here, it ended up being over 6%, almost 7% a week later, straight from this key level of 3,700. Market struggled to go lower. Think about it from a physics standpoint. Think about it from the energy momentum. It's going to take a ton of energy for the markets to go below this level, and in order for it to go below this level, we would want to see implied volatility increasing. In order for implied volatility to be increasing, we can use the VIX as a proxy. Let's actually just clear this up, and then where would that date be? That was November 3rd of last year. So we can see right over here, this would be November 3rd, and we can see the VIX was just continuing to go down. Even when it tried to drop the couple days later, the following week, it just could not hold or get back over this key level. So that right there is the edge in which I look for a lot of the time whenever I'm looking to go long. If I don't see that type of divergence, then I'm not going to have the same level of conviction getting long. On top of that, there's always confluences with technical analysis. That was a nice 50% retracement right here, and I remember that was a very important day because this is around the time I was explaining this within the QTA Discord. Same situation, similar to here, and 50% retracement, very nice retracement here. Similar one, not exactly the same as the one right now, but we can take a look right here. here. It's within the 61% retracement. So this is the market has gone up, it's come back up. And if you've watched any of my videos, you know I like to look for retracements to get long. I don't like chasing the trend and chasing momentum. Everyone that was short these past few days here is now scrambling to get out because no one knows how high the market's going to go. No one knows what's likely to come over the next week here. We have the CPI on the 14th, so the market might just stall out over the next week, or if it does go higher, it might come right back down to this level, or if it just retraces, it's likely to retrace back down to the 4,000 level, right? So that's just a little bit of looking ahead to the upcoming week. I want to jump now to review this because I said I wanted to point this out. This now is the pre-market, so this is on the Monday. Again, this screenshot was taken on the 27th before the market opens. This is kind of an outlook. We took a look at it from the previous Friday, so we already had an idea before the weekend even happened. But now, let's just say you missed that. It's now Monday pre-market. You're trying to decide, you know, what's your game plan? What do you think, you know, what are your levels for the week? You have over 100,000 negative gamma in this level. So you know this is a very powerful level. The market's all the way over here. It means if the market was to continue selling off, if we got below 39, if we got to this level or below it, we want to see implied volatility higher than it was the last time the market was at that level. If it's not higher, then you've spotted your divergence. That's kind of your checklist. Then you want to say, where's the target? What am I looking for? Well, where's the positive gamma? The positive gamma right now at the start of the week was at 401. For those of you within QTA, if you're watching this video, you know that's part of the reason why I was in the, we swung from last week Friday, this 401 flies, which were expiring. So there were 4 left. I think it ended up closing for about 160% return. By the time I got out of the last, positions, these are spreads that this cost, not even $1. I think it was about $1.50 or so. I can try and find it for those of you that are curious or interested in, some of the my trading style or so. So this is $1.35. This was open on the 23rd. So again, this is from the previous Thursday, and was expecting the market by this Friday to be around 4,100. That level came from the analysis in which I did from looking at where's the positive gamma for the week, but understanding that there was a lot of negative gamma for 3,900. So the market was naturally, it was put dominated. People were buying more of that. People were more afraid of XYZ was going to happen. I don't pay attention to the macroeconomic, calendar. It's just the FOMC and the CPI reports. Those are the 2 major catalysts that I'm kind of aware of. When it comes to the things that aren't the inflation numbers, like the manufacturing numbers or the PPI, those aren't things that really are things that I pay attention to. When the narrative changes and the CPI is no longer really driving the market, then the market will move on to whatever is the next thing. At one point, when Trump was president, it was the trade war with China, and then we had the COVID news, and the vaccine news was driving the market. So every 16 months or so, there's a new narrative that the news uses to kind of make traders afraid or pry on the emotions of traders to make people make emotional decisions. But at the end of the day, as long as the market is working the way it does and the options market is continuing to grow, this will be the edge that we have. This is a level, again, if you showed it to an 8-year-old and you said, hey, what's the biggest thing you see on your chart? They're going to say like this one, 390. And then if you said, well, where's the closest green level? They're going to say like, 401. So it's as simple as that. If we go up, we have some positive gamma here. However, I can't think it's going to go up because it's just so much more negative. So maybe we'll go down in the short term. We'll come to around this area, and then we'll probably struggle to go here. If we're close to this level, we're probably going to head back up to this level, and this is kind of where we'll end up. Then if we were to go, where's the line in the sand of where do I think it won't go much higher? Well, we have this red level here, and then we have this a positive level here. This negative gamma and all this positive gamma is important. All right, so this level is 404.50 or 404 or something like that. I can pull this up and we can pull up this exact chart if we want to know. So just so you guys are aware of, or again, this is your first time you've seen this, and I don't really care to get the exact number, but just showing you guys we can. So 404 and 405. I can pull up the absolute gamma. We can actually close the net GEX and actually take a look at how was the call open interest and put open interest at that time, and we can see that there was a lot more put open interest, 81,000 for the 3,900 strike. For the 390 strike, wasn't really that much open interest at the beginning of the week. However, max pain was at this level, so towards the end of the week, we're likely might want to come back to this level if you follow the max pain theory. Close this back out. So that's the beginning of the week. Already have the game plan, already know what positions I'm looking to run. This is the Monday. The market ends up just selling off and we come straight down to that level. Now, if we jump to the Tuesday here, let's take a look. So this is the next day, which would be the 28th. and now the market has dropped down to 33.97. However, I can also, play this out right here, and we can just jump through and see how it was moving, what was actually happening here. And you can see the negative gamma, it's still that negative, it's around that negative 100,000. The absolute gamma is still around here. A lot of the levels, again, I'm not paying attention to every single click or tick that's occurring. I already did the analysis 8 days in advance, already set the positions in which I thought was likely to happen. And then now it's just how do we maximize on this information and maximize on the opportunity. And that's kind of what we're getting to with the 0 DTE options. Now we jump to this would be the Thursday. The market gaps down, and now we're finally close to this 3900 level. Look at how much gamma there is here. It's now over 150,000. This does not add up. Over negative 150 million negative gamma. The spot price now is close to this level, but yet the VIX is doing nothing. The VIX is essentially checked out for the week. The VIX is just falling asleep. How is the market going to continue to sell off? First of all, we're in potential demand. We're in a buy zone here. Again, if I'm trying to refrain from using quant trading app terms, because not everyone watching this video might be within quant trading app. Quant trading app is trying to simplify this information to make it very visual for us. So if you take away anything, it's just like, oh, if the VIX breaks here and we're in the buy zone, then maybe I'll look to get some calls and I'll target wherever strikes have a lot of positive gamma. And the VIX just continued to sell off. It almost makes no sense to think that the market will continue to go lower, at least from an option standpoint. Now, it doesn't mean that this is going to work 100% of the time, because maybe there was breaking news that would have happened right here, and Powell would have said something, or who knows? Anything can happen. It's at the end of the day, it's an organism. The market is still breathing, and it can do erratic things at times that we can't really justify and explain. But from a logical standpoint, why would it go lower with all the context that we know, especially when implied volatility is not showing that the options market is going to help drive it lower? And now we jump to the Friday, and then we can see by Friday the market ended up rallying, and we ended up coming to buy. Let's just jump closer. Actually, let's scroll up here and let's get closer to the end of the day, and we can see we have 400, and then we can see the 404 level. And we knew this a week in advance. Where was the positive gamma likely to stall out? 404, 405. And what do we have? The market ended up closing at 404. So it's not it can seem like a crystal ball or some sort of crazy science or something like that, but this is a screenshot, guys, from a week in advance. This is February 24th, and it's essentially letting us know right here on this chart, a lot of gamma at 390. Market's probably going to keep selling off given the context and price action. However, if implied volatility cannot sustain that type of move, where are we headed? We're probably going to head where there's the first spot of positive gamma, 401. So target a spread for 401 if you trade spreads. If you just like to trade long options and you don't like to trade spreads and you're not an option seller, then to keep this in mind. 401, where's your highest level? 405, because there's not really much interest. There's not really much open interest. There's not a lot of volume past this level. So that's kind of the ultimate resistance, if you will, for the upcoming week. And I've already gone over quite a decent amount of time. I want to just now kind of conclude with a little bit of the options and the opportunity that we have right here. And again, also reiterate, if you're looking, first trigger would have been the VIX. Once the VIX broke, I have all these screenshots again because this was taken before this happened, explaining what was likely to happen, and then I took some screenshots from after it happened for purposes of explaining this video. But here we go. So this was the Thursday. We had max pain on our charts as QTA draws that out as 398. Right here we have, this is the 2-day anchored VWAP. If you've ever heard of this, you can check out any of my previous videos. And we know once we break over VWAP, the 2-day anchored VWAP, we're now back on front side strength. We can think of it that way. Anyone that's been scaling into their short position the previous day are going to look to start getting out of their positions. So now we have trigger, we're back over the 2-day anchored VWAP. We're breaking a trend for the week, if that's what you're looking for your trigger, all those types of things. But you should be able to identify and spot this from here. We also have the SPX, in which we were looking at. The SPX showed this ascending wedge, ascending, triangle, all the different, everything in which you've read. I've read, like most traders, I've gone through a ton of books. I've been doing this for a few years, so there's so many different ways to explain one course of action. All of that ends up just receding to the back of your mind once you've consumed it. It just ends up falling into your subconscious. I don't need to draw the levels on my chart and draw triangles and draw trend lines. You can just look at a chart and be like, oh yeah, there's a trend right here. I can kind of just see it. You don't need to draw it out. It ends up lining up with 39.80. So that's just an extra reason of confluence for where might be the area that you're interested in. Now, if we take a look at the options itself, this was the 39.80. So now you guys should know why 39.80, because those are going to be the first questions, like, oh, why would I grab the 39.80 call? It's because if you have a really small account and you want something that's low risk, this thing was going for 15 cents. So $15, literally $15, 15 cents. You can get, 3-4 of those, however much your risk tolerance is, and say like, hey, if we end up doing the power hour squeeze that I've seen happen hundreds of times, depending on how long you're trading, this is almost a 700% return. That's $50 from, and I'm basing it based on this 50 cents fill, because I'm pretty sure someone might have gotten a little bit lower or so, but your average, if you bought a few throughout the day, is probably going to be around 50 cents or somewhere around 50 cents to $1. And I just put this line here as in a sense when it's first hitting that 39,750 level as potential sell target or something like that. And then these are some ridiculous levels in which it hit, because it ended up going in the money, which was crazy here. Again, this is the SPY on the left hand side, but you guys can just do the conversion and just know that this is essentially the same area on the SPX. So that's the 0DT. But now if you don't like trading 0DT options because it makes you nervous, because it's crazy risky, even though it's only 50 cents, and relatively speaking, depending on your account size, I don't think anybody that trades options can say that a 50 cents option is expensive. If it is, I think you should probably focus on trying to save up some more capital to be able to trade with an account size of around $2,000 to $3,000. Even if you're trading with a $2,000 to $3,000 account, a 50 cents option should be something that you should be able to manage, especially if you're just getting one. Now, if we take a look at a couple other options, for example, this is the 1 DTE, so this is the 39.80 call option for the following day. We can see this is going for $5 around the same time here, and just using this as basing, it was at $5 multiple times throughout the day. This is hours in which it was kind of building up, and then once it hits a first potential profit target, that's already 180% return, or $900. This is the gap up, so if you sold it at the open the next day, I usually like to track that or take note of, because half the time, if I'm in about 3 or 4 of these, I'm definitely selling at the open if we get the gap up, because you never know if it's going to fill the gap. So I always used at the open if you have size to be able to get out of your position. But this is a 400% return right here, so $2,000 per one contract. And then by the time this thing hits, this is the opening drive, so at 10 a.m. Eastern time here, also another place to take profit. So I like to use this whenever I'm tracking information. And then we have your sell zone here if you're a QTA member, for when you should essentially be looking to get flat the last piece. But at this point, this is 775% return, almost $4 return from $5 from using this type of data or information. Something that might have been a little bit even for a smaller account is the 4,000 call. You're thinking it's probably not going in the money when it's all the way down here, but it doesn't have to go in the money for you to make a ton of money. This contract ended up going, I don't remember, but I think it hit $59, so almost $6,000 this contract ended up being worth, whereas at this point it was going for $1.70, the low of the day, but we're talking about opening it around $2 or so as it was consolidating, maybe grabbing a couple, and it's a 1 DTE. So if the trade didn't work out within the same day, I did not think it was going to work out within the same day, because everything in which I was writing in the Discord was for the following day, for Friday. I was trying to prepare everyone for what was likely to happen for Friday. Again, it ended up working out the same day, because this was already a monster trade here. You're talking about 500% return, so from $2 to $12 on this move, not knowing or not thinking, it still had another 1,000% and then another 1,000% to continue to go here. So those are just some examples, guys, of the opportunities and the potentials of that we're getting within the market right now. SPX 0DT options is actually something that I don't have that much experience with, because at one point when I traded mostly options and I would just be long a call option, a long a put option without a spread, I traded the SPY, and that's where most of the liquidity was. There wasn't the Tuesday and Thursday 0DT options that happened. So most traders that I knew, we traded the SPY and we just size up into the SPY. And if you traded the SPX, it was a little bit risky because the liquidity wasn't there and there was a very wide bid-ask spread. So it was kind of nerve-wracking to get a $10 SPX option where the bid might have been $9 and the ask was 11, and there was maybe only 50 volume for the day on that contract. You avoided it. So I'm still coming from a little bit of that background, and then I trade mostly spreads. So I haven't been paying that much attention to 0 DTE SPX options or 1 DTE SPX options, but now I know, as of the past 3 weeks, as I've been paying a little bit more attention to it, there's definitely a lot more opportunity because there's no spread that you really could have traded that would have given you the same potential here, the same opportunity here. Because if you targeted the 400 butterfly, it wouldn't have been worth it as much. If you targeted, even the 405 fly, that would have been a ridiculous trade to be grabbing the 1 DTE 405 long call butterfly. But just grabbing the 405 call option, probably was going for 10 cents at that point, 5 cents. It's a better opportunity, and you're taking advantage of the opportunity in front of you. So there's also the opportunity cost. So as per usual, sorry for making another really long video. I think I intend on making a shorter version of this, something that can be under 10 minutes to kind of summarize a lot of this, and then I'll just reference this video for those of you that really are people that really like to get more information and really have deeper explanations to what's going on. But this right here, if there's anything, save this. I've mentioned this before when building out a playbook. You're seeing right here, this is exactly from my playbook here. If you see this, and usually after big moves in the market, if it's been down a lot and then you see it bounces and then it goes back to that same price, and you do the same thing with the VIX. The VIX has been going up, and then it drops, and then it does not go back to the same price. This divergence, usually if it's greater than, if you want to know if it's greater than about 7%, again, that's not really that important. If you can just see it on the chart, then that's significant enough. But 10% is usually a decent spot just from my findings. And leave a comment down below if you learned something. Like the video, share it, subscribe. More information on Quant Trading app is in the description, and if you're interested in the Discord, the Quant Trading app Discord, the link is in the description. There is a public section. I'm not active there. The access to all of this data is part of the Gold membership, and it is on the Quant Trading app website, and that's how you get access to all of these levels, as well as the access to the archived data, and there's a ton more to go over within these levels here. But thanks for watching, guys. As usual, thanks for watching, guys, and I'll catch you in the next one.